Hello and welcome to Simplicity in Stocks. If the recent stock market correction has hurt your financial condition, then this video is for you. The stock market sentiment has shifted from overwhelmingly positive last year to cautious at the start of 2025 and now to negative. Even fundamentally strong stocks that were going up have now reversed direction. Mid-cap and small-cap stocks in which retail investors were heavily invested have fallen much more than the Nifty. This is why we at Equitymaster have always favored long-term investing. You see, investing in fundamentally strong stocks for the long term allows an investor to sleep peacefully at night, knowing they don't have to constantly check the stock price every day. This kind of investing is also a way to potentially maximize returns while keeping risk under control. Equitymaster's editors have learnt a priceless lesson about the stock market during their decades long stock picking experience. Here it is. When you become a long term investor, you put yourself in a position to beat the market. Why is that? Well, it's because the stock market rewards those who successfully apply the rules of long term investing. So, what are the returns given by the market in the past? And what returns can you expect from stocks in the long term? Let's find out. But first, do keep in mind that this video is for information purposes only. It is not a stock recommendation and should not be treated as such. There is no opinion or view on any stock covered herein. Now, let's come to the long term stock market returns. If we consider the BSE Sensex, it has given a return of about 15% since inception on a CAGR basis. However, a more meaningful long-term measure would be about the Nifty over the last 15 years or so. This would cover more than one market cycle and it would give a more recent performance figure. So this is the Nifty performance in the last 15 years. We can see that the Nifty has multiplied about 4.5 times over the last 15 years. This is a CAGR of about 10.75%. This return should not be surprising. After all, it's about the same as India's nominal GDP growth rate. That is the growth in the overall size of the economy, including the effect of inflation. To understand long-term stock market returns, the nominal GDP growth rate, which incorporates inflation, is important to understand as opposed to the real GDP growth rate. This is because the benchmark stock market index like the Nifty is supposed to be a barometer of the economy, at least over the long term. So the Nifty's long-term returns should ideally not deviate too much from the growth in the size of the economy. And that is mostly what we have seen in the past. Of course, this is not a scientific way to study the stock market returns, but it works well on a practical basis. So what about the future? Well, let's make a simple assumption that the future growth rate of the economy will be similar to the past. Then we should conclude that the Nifty and Sensex should deliver returns similar to the past, that is about 10% CAGR. Now, is this a good assumption to make? Well, the nominal GDP growth of an economy is the growth measured in current prices, that is, incorporating the effect of inflation in the economy. This enables us to use a rough formula here. Nominal GDP growth equals real GDP growth plus inflation. Now we know that this is not the actual formula, but for our purposes it is sufficient. If India's real GDP growth over the next 10 years averages about 6 to 7% and inflation as calculated by government statistics averages 4 to 5%, then we get a nominal GDP growth of 10 to 12%. Let's consider 10% to be conservative. This should result in the Nifty delivering about 10% CAGR over the next 10 years. Of course, this is a simple calculation, but it has worked in the past and there is no reason to believe it won't work in the future. Now, do keep in mind that such rough calculations work only over the long term, like 10 years plus. It might not work even over a 5-year period. Thus, we can arrive at the following conclusion. The returns for stock market investors over the next 10 years should be similar to returns made over the past 10 years. Risks. No discussion of a stock market returns is complete without considering the risks of achieving those returns. This is vital. So, what could hurt the chances of the economy from achieving a real GDP growth rate of 6 to 7% and a nominal GDP growth rate of 10 to 12%? Well, we can think of a few things. One, high inflation lasting many years. While this might artificially boost nominal GDP, it would be a disaster for the economy because consumption would fall drastically. This would in turn severely affect revenues and then profits of corporate India. Two, wars. This is self explanatory. Three, a pivot to socialism. If market reforms are abandoned or reversed by the government, then it would take a heavy toll on the economy. And four, business as usual attitude. The world is an increasingly competitive place. India cannot rest on her laurels. If the government doesn't show urgency in reforms, there is a real risk that the economy might get stuck in a phase of low growth. Conclusion. So, what market levels can long term investors expect? A steady 10% CAGR for the benchmark indices would result in a Nifty level close to 60,000 and a Sensex level close to 2 lakh by 2035. This is neither an aggressive nor conservative forecast. In fact, it's not a forecast at all. It's just what you will get by plugging in the values into the compound interest formula that we learnt in school. That is x equal to p into 1 plus I raised to n. Here, p is the present market level, which is around 22,500 at the time of recording the video. I is the assumed growth rate, 10% in this case. N is the number of years, 10 in this case. X is the final index value. Now, if you think these levels are unrealistic, just remember that back in early 2010, the Nifty was around 4,500. At that time, the memories of the global financial crisis and the huge bear market of 2008 were fresh in everyone's minds. Back then, if you made a prediction that the Nifty would soar past 25,000 within 15 years, few investors would have agreed with you. Now, this doesn't mean that you can just go out there and buy any stock in the market. You will need to select fundamentally strong stocks, prioritize corporate governance and capital allocation skills of the management, and buy stocks that are reasonably valued in terms of PE and PB ratios. Investing in stocks based on faith or rosy assumptions or fancy stories will